In this recording, we're going to look at some of the entities that you may need to deal with as part of advising people on their tax obligations. The most important of these entities is, of course, the Australian Tax Office itself. This is a statutory body created originally under the Land Tax Act about 100 years ago. That is the primary entity that deals with collecting federal government tax. So this is the main system that our federal government uses in order to assess taxpayers and really fund all functions of the Australian government. However, there are some other entities that we will need to look at one by one. Primarily, though, the powers of the Australian Tax Office and the Federal Commissioner of Taxation we're going to go through and look at in a little bit more depth. The Tax Administration Act states very simply there must be one and only one Commissioner of Taxation. This person is appointed by the Governor-General, which in all practical terms means that it's the Governor-General acting only nominally and following the advice of the government of the day. The legislation also states that there must be 3 second commissioners of taxation, no more, no fewer. Possibly the most important function that the Commissioner has is the ability to delegate. The Tax Office has tens of thousands of staff. The Commissioner, while responsible ultimately for the governance of the ATO, doesn't perform many functions directly. So the Commissioner is given very, very wide scope to delegate powers. In fact, there are only 2 substantive things that the Commissioner can't delegate. One of those is the power to delegate, and the other one is a requirement that the Commissioner furnish an annual report to Parliament. So the second commissioners essentially can step into the shoes of the Commissioner for everything listed in the statute that the Commissioner is required to go through and do personally, other than those 2 functions. One of the more interesting things that the Commissioner can do is to create what is known as disallowable legislative instruments. What these do in practical terms is to override tax law. Now, you might think that that sounds like a very large step of executive overreach and giving ultimately very wide discretion for the Commissioner to do things. However, in practical terms, the Commissioner, in order to create these instruments, has to be satisfied that all practical steps have been taken, and that involves consultation in regards to a particular taxpayer, and that the particular instrument that's about to be created still aligns with the intended purpose of the particular provision, and she or he needs to take into account a variety of factors that are listed in the legislation. And finally, the Commissioner also must have a written report from either the Treasury or the Department of Finance stating that a particular instrument won't have an impact on the budget, the Commonwealth budget. So these instruments that can be created by the Commissioner, usually they relate to particular situations involving particular taxpayers. And there's a couple of things to note there, that where an instrument such as this is created, a taxpayer that's impacted by such a modification to the tax law is not to apply it if that modification is going to lead to a less favourable result for them. So that the idea is that all of these disallowable legislative instruments that the Commissioner can make must be for the benefit of taxpayers. If taxpayers would suffer, they are actually not. It's not that they're not obliged to follow those instruments, they must not follow them. I think an important thing to note in contemporary Australian society is that we're heavily regulated and we have a large amount of bureaucrats who produce policy instruments. And those policy instruments are there to guide the organisational unit that they're in, or in this case, the entire tax office itself. And so the Commissioner has created such a policy instrument known as the Taxpayers Charter. And that's basically a mission statement that you would find in the business strategy literature, essentially saying that the purpose of the tax office is to try and foster economic and social well-being. It's to encourage willing participation in both the tax and the superannuation system, and to make it easier for them to go through to do that in order to essentially minimize the transactional cost to taxpayers themselves. I think it's really important to note, though, that like a lot of policy instruments, that it has no legal force. Government agencies issue policy instruments all the time. They are there to provide consistency of administrative decision making. They are not statutory instruments with force of law. Neither are they private or agreements akin to contracts. So it's really important to note that while this Taxpayers Charter gives the strategic direction of the ATO, it doesn't have force of law. Another important thing to note is that in situations where the tax office does make mistakes, either they give improper advice or ambiguous statements, or they administer the law incorrectly, and it can be demonstrated that the ATO is at fault and demonstrated by the particular taxpayer that they have suffered harm, that taxpayer can apply through the Compensation for Detriment Caused by Defective Administration, or CDDA scheme. So this is a statutory scheme whereby essentially a pool of money is established and applicants can simply apply, and the particular decision is looked at and examined by a body as still a member of the tax office themselves, and a decision is made as to whether or not compensation can be available under this scheme. Now, where a taxpayer is refused compensation, they can seek all of the ordinary administrative law remedies. That is, you can ask the administrative decision maker to remake the decision. You can ask for an internal review in the tax office. You can ask some other entities to go through and examine a particular refusal, including the Commonwealth Ombudsman or the Inspector General. Finally, you can seek judicial review. In other words, you can ask the court to essentially look at the lawfulness of the decision and grant some form of order. And those follow the classical steps of judicial review in the federal system, such as through Section 75 of the Constitution itself, sub 3 and sub 5, as well as Section 36 capital B of the Judiciary Act for review in the federal court. Important piece of law to note for new lawyers is that when you are dealing with tax matters and when you are dealing with the tax office, that they do not owe you a duty of care in tort. What does that mean? It means you can't sue them for compensation at common law. Now, there has been some judicial commentary that a duty might arise in some situations, but the overwhelming body of judicial commentary on this area is that you cannot sue the ATO for negligence in tort. There is a body that has been established which examines the tax system as a whole. In other words, looks at the integrity, looks at the effectiveness, and performs whole of system investigations of the entire tax base across Australia. It's known as the Board of Taxation. Note that the Board of Taxation is not a statutory body, so it's not created or crafted under legislation, merely by executive determinations. Also note that the board is, in its own sort of mission statement, is established in such a way for it to not really go through and investigate either the ATO itself or individual taxpayers. It's really in a position to go through and undertake research and provide the results of that research to the Treasurer directly. Imagine most of you listening to this recording are aware that accounting and law are both professional disciplines. And as such, there are certain accrediting agencies who examine your qualifications and examine your level of continuous professional development, as well as certain matters to do with your fitness to practice in a particular area and make determinations. So essentially they regulate that particular profession, and they're allowed to do that under statute. Now, the Tax Practitioners Board, or TPB, is the equivalent for tax practitioners. So that's tax agents, BAS agents, and tax financial advisors. So that if you're seeking to basically become admitted to the TPB to be able to perform tax-related services, you will be subject to the rules and regulations issued by the TPB. Now, note that like the CA, CPA qualifications and the various law societies, the Bar Association of Queensland and the QLS, for example, here, that the TPB can issue sanctions. So that part of the process of becoming connected or part of these associations and becoming a practitioner, while it gives you the benefit of being able to access this protected monopoly, you also can be liable for more than merely being removed from that organization as a member. You can also be liable for offences, for breaches, and to be fined. So make note that the Tax Practitioners Board is the key entity that governs tax practitioners in Australia. The Inspector General of Taxation and Taxation Ombudsman, which is one office, is essentially an independent investigative and reporting entity. The IGTO, is the acronym, has powers given to it under the statute, the Inspector General of Taxation Act 2003, to go and investigate administrative actions of both the ATO and the TPB. So the IGTO, much like Ombudsman in other spheres, can both investigate complaints that have been made by particular taxpayers or practitioners about the tax office or other entities, including tax agents or tax lawyers and tax accountants. And they can follow up these complaints and investigate and make reports. They can also take actions of their own volition. So they can get up and go and make investigations and to go through and do these reports. Now, note that much like Ombudsman in other spheres, they're given quite extensive powers to investigate and report, but they aren't given powers to actually do anything. In other words, to change decisions, to alter the decisions of the tax office, assessments, or things in really the financial results of any decisions of the tax office or the TPB. They can merely report those findings. I'm going to turn now to the affairs of taxpayers. We're going to start by looking at this duty of confidentiality that agencies have in regards to the affairs of taxpayers. Sometimes tax information that is generated will actually have with it a very, very strong amount of privacy associated with it. You may have watched TV shows or seen movies about situations where police agencies are seeking information from tax office and tax people, and that information isn't provided. And the idea from a public policy perspective is that we, regardless of what people do in terms of the lawfulness or the criminality of that conduct, we want people paying tax. Why? Because if people don't pay tax, the whole system doesn't work. So thus, famously, Al Capone, the Prohibition-era gangster in the US, was found guilty of income tax evasion rather than all of the other crimes that he probably committed as part of that period. Now, note here the test we use in Australia in terms of whether or not information is disclosed to various law enforcement officers is one where that disclosure must clearly outweigh the need for taxpayer privacy. It's quite a high bar, but it's important to know that in Australia it is not absolute. So that if things are criminal in nature and they do involve tax affairs, that information does not have an absolute protection associated with it. As you can imagine, the offences themselves for unauthorised disclosure are expressed in very, very broad terms. So basically a person who is either a tax officer or provides services to the Commonwealth or the ATO, or both, performs functions for the purposes of taxation law, who records or discloses information, or even information given to a court or tribunal. If this information is protected information, that is, it's to do with tax affairs of a person, the person adducing this information or disclosing it commits an offence. Okay, now that seems a little bit strange. Usually for information that's given to, particularly things like courts and tribunals, usually there's given some immunity here. Not so with tax information. I said it's a very, very high bar. The affairs of taxpayers is considered to be very confidential. Now, another curious thing to note here is consent is not a defence. So if the person who has this tax information consents to it, actually isn't a defence to any of the offences under the Tax Administration Act. Another thing you might want to know is that taking action in a court or tribunal to try and obtain tax information is in itself an offence. Okay, so bringing about an action whereby you will be trying to obtain or seek another person's tax information is an offence, other than, in a particular exception, which is the Freedom of Information regime. So note to self, if you wish to obtain tax information about another person, make sure you fill in the FOI form. Do it properly. We do note that in addition to the offence provisions that are in the Tax Administration Act, the General Privacy Act, the 1998 Privacy Act, will still apply to that information. In other words, the ATO, being a statutory body, when it collects information, they have to take safeguards. They have a positive duty to ensure that that information can't be lost or others can come through and access it without authorization. And where the information is held by that body, that it's used for the relevant purpose. So then, what data does the ATO have about you as a taxpayer? Well, the ATO collects data from a variety of sources. Some of them are obvious, so when you, for example, submit an assessment each year. Some of them less so. So the ATO does cross-checks and can generate additional information based on data that it has, but also data that it is entitled to collect across other government agencies, such as the Child Support Agency. The information can also be referred to it from other agencies directly, including the police in both the state and federal jurisdictions. The ATO also monitor media releases, and that can have information in it to do with particular taxpayers. Evidence can be adduced in royal commissions or through court proceedings, and a remarkably powerful source of information for situations where taxpayers aren't doing things properly is anonymous tip-offs. That is an area the ATO gets a remarkable amount of information about non-compliance from. Also note that the ATO is an ordinary litigant, must follow the model litigant rules, but in regards to the discovery process, once the ATO has entered into litigation with another party, that the information that is given to it as part of discovery is or forms part of the ATO's data sources in regards to particular taxpayers. I will note at this point that an important and very powerful source of data comes from taxpayers themselves. Why? Because taxpayers are obliged under the 36 Act to keep records. And so persons carrying on a business are obliged to create and keep a series of pieces of information in a very clear format. So it must be either a hard copy or electronic. And if they're electronic, they have to be readily be able to be converted to a hard copy information. Those records must be in English or, again, must be readily convertible into English. The information the taxpayer must keep is to record and explain all transactions and other acts that have been engaged in by the person that are relevant for any purpose of the tax legislation. Basically, it's expressed in very broad terms for a reason, that the ATO really tries to encourage taxpayers, and again, these are taxpayers in business. So if you're carrying on a business, you have these requirements. The ATO wants these taxpayers to record things so that they can be checked and cross-checked afterwards. And that source of data is in and to itself useful both for ensuring compliance on behalf of the taxpayer and in situations where that compliance hasn't been met for the ATO to be able to take action. One of the things to note about these taxpayer records is that while they don't have to be in a prescribed form, they must be able to be converted into something that the tax office can understand. So again, both either a hard copy or a digital copy. They have to be in English so that they can be read by the vast majority of the ATO staff. And they have to make sense in the accounting world. And that is that the records must be able to demonstrate income. You must be able to calculate income and calculate deductions. The taxpayer is also required to record any particular choice that's been made under the legislation. So in situations where a taxpayer has an election, that must be recorded as well. So it's worthwhile just to note this at this very point, that going forward for your own records and for others that you're assisting, that you should write out a statement, keep things in writing and document them as well as you can from this point going forward. Note that records have to be kept for 5 years. And if there is a situation where the circumstances require you to keep them for longer, you must keep them for longer. And the classic example of that is where you've got a tax loss which is carried forward. You would be wise to also do such things where you have something like a capital loss as well, which is carried forward. You'd be very wise to retain records for longer than 5 years in those situations. If you don't keep records, you're committing an offence, and the fine for the offence is 30 penalty units. Penalty units are between $200 and $250 at the moment, and they periodically increase. They're in the 1914 Crimes Act. So it can be quite a large fine simply for failing to keep records. And also note that there's no excuse availed to a taxpayer who carries on a business in regards to records, because it basically is an offence of strict liability. So whether you thought the records were kept or you have an honest and reasonably held belief that the records have been kept, and if they're not, you're still going to be liable for that fine. So this is where things get interesting. The ATO powers to get taxpayer data. From the outset, I really should explain that the powers the ATO have are outrageously strong. They are vastly stronger than any other government agency. The ATO have more power to go through and enter premises or compel people to come and give evidence than the federal police, for example. The ATO's powers are extensive. And again, it goes back to this idea that if we don't have a functioning tax office, we don't have anything. All of the other government agencies fail without the revenue being able to be protected. And so they form two areas. So you've got the one power, which is in This is in the Tax Administration Act, section 353. So the section or subsection 15 is the enter and search power, and sub 10 is the compelling power, to compel a person to either adduce evidence, either through producing documents, or to attend and give oral evidence as well. So I'll go through each of these first, starting with the former one, the entering powers. Just before looking at the individual powers themselves, I'm just going to mention that this idea of the dual character. What that means is that we don't want to give government agencies power to interfere with our personal freedoms and liberties, and taking our properties and coercing us to do things. We don't want to have this in an ideal or just society. However, if we don't have this, the entire system can collapse. And unfortunately, there are people out there who will go through and try to avoid paying tax. And as such, the balance that we have, this, on one hand, we want to preserve liberties, and on the other hand, we need to have a functioning tax system. It's very much in balance between those two things. And so we note that while we give the tax office a lot of power, the interesting thing to note is that in Australia, that power by convention isn't misused quite so much as what would be readily apparent from the breadth of the power. So it's something just to note, much like our Governor General, for example, has a collection of reserve powers. They very rarely use them in an improper way. So starting with the powers to enter premises and to inspect documents, there are four, I guess, subparts to this. So basically, the commissioner, not obviously the commissioner herself or himself, but a delegate nominated by the commissioner, is empowered under 353-10 to, at all reasonable times, enter and remain on any land, premise, or place. Okay. They are also entitled to full and free access, again at all reasonable times, to any documents, goods, or any other property. They can inspect, examine, make copies, or take extracts for any documents. And they may inspect, examine, count, measure, weigh, gauge, test, or analyze any goods or other property, and to that end take samples of those. So provided that things are done within the scope of taxation law, so not just broadly in scope to go through and enter anyone's house, this is expressed in very, very broad terms. So the key things to note is that the tax office at reasonable times is able to enter premises and inspect documents and make copies. One thing to note there that tax office isn't allowed to do under 353-15 is to take the documents away. They can make copies, but they can't take the documents away. So when we're breaking down exactly what these powers mean, there's a couple of things to note, and these are all good for the ATO and bad for the taxpayer who may not wanting them to arrive and take copies of documents. First thing to note is that they're essentially unrestricted, other than they have to be for a bona fide purpose, and they have to be to do with a matter of taxation or under taxation law. Okay, they are given full power to enter or examine all parts of the relevant place or building. They can go anywhere in the building. It doesn't have to be confined just to where the documents are. They have power to examine all of the documents, not just particular ones that a taxpayer thinks relate to issues of taxation. And this one's a pretty big one. They can use this power for what we call a fishing expedition. What does that mean? It means that if they think there might be a breach, they can go through, use the power, go in there, look at all of the documents, and then determine whether or not a breach has actually occurred. That's this idea of a fishing expedition, where they don't have hard evidence or proof of a particular offence happening. Note that they aren't confined to records relating to people who are there, and they're also not confined to tax records related to the persons that are that they're intending to go through and investigate as part of this. Another thing to note is that the contractual duties of confidentiality, or duties that would otherwise provide a way out, in other words, it would be unlawful to disclose information, are going to be overridden by this power. And the key ones to note here is that banking and customer, financial advisory client, accounting client. The last one, interestingly, is solicitor and client. So the contractual duties that a solicitor has with a client will be overridden by the powers to enter and inspect. What then are the limits to these powers to enter and inspect? Well, there aren't many, but they really fall into three categories. The first is the reasonable time of day. These powers actually changed about 5 years ago, and it used to be that the type of premises mattered, and that if it was a business premise, we would have one set of rules, and a non-business premise had another. And they've modified this for it to be to do with the time of day, and the time of day does matter in regards to the particular zone or where the premises are located. Second thing to note is it has to be for a bona fide purpose, so that while I mentioned that things can be done for a fishing expedition, there still has to be at the heart of it some genuine concern that there is a taxation law-related problem. And that's the reason for them to go through and enter premises and inspect documents. And finally, and this is one we'll delve into in significantly more depth, is that the powers are limited by LPP, which is legal professional privilege. I'll talk about that in more depth a little later. Some things to note for anybody listening to this recording who may end up going on to be a tax advisor, either in an accounting or a lawyer capacity, is to do with notice. This is where things move away from the things done by law and mechanics of law under the Act and things that are done by convention. Because by and large, the ATO, by convention, will give notice. So they don't have to, but they usually will. And so situations where, however, the ATO genuinely fears that if they do give notice, that documents are going to be destroyed, or that it's in some other way that the particular taxpayer may sort of thwart or frustrate the entire investigation, then they might actually arrive without giving notice. So you basically use the enter and inspect powers without notice. There are other situations where banks, for example, actually have obligations to not voluntarily give information, and that flows from contractual duties, and so that will also apply to many situations for you if you do operate as an accountant or as a solicitor. Not that that's placed upon you by the general law. Usually, though, it may be a term of the contract that you won't voluntarily give the information away. And also notice that history goes a long way in regards to the ATO's provisioning of notice or not. So people that have a history of non-compliance, it's much less likely the ATO are going to give notice that they're going to enter premises and inspect documents. Some more things to note, and again, you may be noticing something of a theme here, in that all of these powers are stacked up to the favour of the tax office, and they are. They are given a very large amount of power to go through and enter premises for tax-related purposes, vastly more than other government agencies. And so a key thing to note here is that you don't have an action for anything in judicial review in regards to natural justice. So that just doesn't apply in regards to the ATO using these statutory powers. You also might want to know that when the ATO comes knocking, in terms of knocking your door down, they are empowered to literally knock your door down. So if situations where you either refuse to or you can't open things like safes, then they'll do it for you. So they can literally knock your door down and literally crack your safe in order to obtain documents as part of this. They're given that power under the statute. Also note here that the two powers can be used conjunctively. Okay, so that there is this reasonable time for access. In other words, the ATO can't come knocking in the middle of the night in a residential property, for example. But note that the notice provision that we talk about in regards to giving notice to compel a person to appear, in other words, from the other power, which is in 353-10, that if you do give notice for a person to attend, that's not going to change the requirement for a reasonable time of entry as part of the 353-15. I guess when we're looking at the other very, very strong collection of powers, that this power that the tax office has to make people either give information or actually attend the tax office and provide evidence or to produce documents. The key thing to note is that this has to be done with notice. So unlike 353-15, which essentially the power to enter can be done without notice, this one by definition must have notice. You must ask people to give this information first. It has to be done in a proper form, has to be done in writing, and has to be served upon them. So this information power, though, much like the enter and inspect power, is still expressed very broadly and gives the tax office a very large amount of coercive tools to apply to taxpayers and to those related to the creation of tax information. And they apply in a very, very broad way. Normally, the rules of evidence will apply in things like court proceedings, where a person is not obliged to produce evidence that's going to incriminate themselves. There's a rule of evidence. However, the powers given to the tax office under 353-10, those things don't apply to it. So this power that the tax office has is going to trump this privilege that you would normally have against self-incrimination. You are obliged to attend, you are obliged to give evidence, and if you refuse to do that, then all of the penalties are going to apply to you. Note that there is another rule, and this comes from this Harmon and Secretary of State for Home Department, that normally when evidence is adduced, so again, the documents or testimony is being adduced, that there is a rule of evidence that forbids that from being used for purposes other than for which that evidence was given. So in other words, if you're asked to adduce some evidence for one purpose, that cannot be adduced to the courts for another purpose unless leave of the court is given. Okay, that's the usual rule of evidence. However, in regards to 353-10, that rule doesn't apply. So testimony that's obtained under that power can be used for other purposes. Those normal rules of evidence do not apply. Also note that you don't have to be a taxpayer in order to be given one of these notices, so that you literally could not be an Australian taxpayer at all. But if you are served such a notice, you are nonetheless obliged to go through and adduce evidence, furnish information, or produce documents if stated to on such a notice. However, if you can't do that, so it's logically impossible to go through and do that, for example, if you have literally no idea what this is about, or if in a situation where you don't have access to the information, then you have to comply with as much as you can, but you can't be found essentially guilty under the provision for doing basically the best you can under it. So if you're unable to do so, then you won't be obliged to comply, and you won't be found that you've breached that and committed an offence. Some things to note about how the tax office has to request that you furnish information is that this information definition is very, very broad. So it's very broad in terms of how it's been expressed. And even more so, the ATO, again, this has been found by the courts, ATO actually gets power under the section, or most of these cases are under its predecessor, to actually take the information that you've given and do other things in relation to that, to speculate, form an opinion, draw a conclusion from that information. They're not going to put words in your mouth, but they can require you to actually think about the information and essentially synthesize things as part of that. Note that another thing to note about this is that when the ATO is requesting information, that information doesn't actually have to relate to the recipient. It's information about tax or tax affairs in regards to the administration of the legislation. It doesn't have to be specific to the person who receives the notice. So make note, it doesn't have to relate to the particular recipient of the notice. That person is still going to be obliged under these very, very strong powers to furnish such information. With the obligation to attend, this is not a judicial power. So what does that mean? It means that if you fail to attend, you won't be found guilty of contempt, but you will or can be found guilty of an offence under the Act itself. So note that in a situation where an officer does give you such a notice to attend, you are obliged to attend, and it is an offence if you do not turn up. With situations where the ATO is requesting documents, they can ask you to produce documents which are in your control, and that custody or control is expressed in very, very broad terms. Look, this one is perhaps a little bit more challenging in terms of the evidential requirements in order to be found guilty of an offence. Nonetheless, it is still expressed in very broad terms, and the custody and control is a very low bar, and so that you are required to take steps in order to obtain those documents. You can't merely say that they're not within your immediate vicinity. It doesn't sound particularly intimidating, I know, to hear or receive notice that the tax office is coming on site in order to inspect your documents. And I imagine that if I was a large criminal organisation, that I wouldn't be particularly worried about the nerdy types from the tax office rocking up to try and get our computer files. However, note that it's very, very rare that the tax office themselves are going to arise, certainly in situations where there is going to be trouble. In other words, where they think that the people are going to be uncooperative, or in a situation where they think that they won't be let in. I mentioned the situation where the tax office is entitled to break your door down to come in and get your documents. This is correct, but in almost all circumstances, that won't actually be undertaken by the tax office itself. It's going to be undertaken by the federal police, because each of these sections, the 353-10 and 353-15, have criminal penalties and sanctions associated with them. So in situations where there is or is likely to be a criminal offence, the federal police can be called in. So they can be called in by the tax office through the issue of a federal search warrant. There is a little technical piece of law here, though in practical terms it doesn't make much difference. The thing is with a search warrant issued by the federal police is that they are going onto premises under a search warrant in order to obtain evidence regarding an offence. Now that's significantly narrower in scope than what the powers that the tax office have, you might have noted. However, as part of this process, the federal police will get a search warrant, but the ATO or officers of the ATO will assist them. The idea being that in regards to the offences, that the federal police are not experts by any means, and they aren't in the position to identify which documents are likely to relate to which offence. And of course, as you can sort of see, put two and two together here, that once the ATO are inside, they still have their outrageously strong powers under Section 353. So once they're inside the building, they can do ordinary tax office things, which they have wide scope to go through and look at places and inspect things. So look, it seems a little bit glib how this has been put together, but in practical terms, actually seems to be a nice sort of a balance between the two. As part of that, it's certainly far from being a misuse of process, because by convention, the ATO only use this power in situations where they have a real and genuine need to access premises where there's going to be some likelihood of an offence occurring. Of course, when the police are involved in things, their search warrants are far more limited in scope, so that they don't have unrestricted access to get whatever they like and arrive whenever they like. And we in our society quite deliberately limit police in terms of their discretionary power to go through and do things. So in regards to this issuing of a warrant, the ATO has to demonstrate that there are some reasonable grounds of suspecting that there's going to be, over the next 72 hours, an offence in the premises that are nominated in the warrant. Also note that much like the restrictions precluding information and documents being obtained by the tax officers where they're subject to legal professional privilege, the federal police are also not allowed to take and use documents that are subject to privilege as well. So LPP applies both situations. I'm going to look now at what LPP actually means. So the key takeaway that we've had in regards to the powers of the federal police and the powers of the tax office is that in both situations, that they can't take documents that are subject to privilege. That is this lawyer or solicitor client privilege at common law. The privilege at common law is really underpinned with this balancing act. And some of you that have studied the ins and outs of legal ethics will know and understand how this works, because the point is that we want to have systems where you don't have unrepresented litigants go to court. That is a disaster. When you have people that don't know and understand the legal system, it clogs the courts up and it wastes everyone's time. The results are poor. So we want people to be able to be represented. And in order to do that, we need to have systems in place where people that go to lawyers to seek advice for those lawyers to represent them are trusted. And they have to be trusted not just from an interpersonal perspective, but also be able to really incubate this trust, so much so that the client can make very frank disclosures to their legal professional, their representative. Why do we want that? Because we want people to be able to do this so that we get legal professionals in court who won't clog the system up to the same extent that non-represented people do. As a result, we place a very, very important, it's almost a sacrosanct amount of weight on this legal professional privilege. The information which is adduced from a client to a solicitor in circumstances of confidence where they're seeking legal advice. So that's really the reason why we have LPP and why it's so important. A couple of important things to note about LPP is the dominant purpose test, is this paramount test. So basically, you can only get legal professional privilege, and so information that the tax office or the federal police might otherwise obtain, they won't be able to obtain it if you can demonstrate that the dominant purpose of the particular document is a communication which is in confidence that is for the purpose of obtaining legal advice, or documents that are used in pending or anticipated actual, or what we call quasi actual litigation. So what do we mean by quasi litigation? Going to things like tribunals. So that dominant purpose test is the overarching test that is used for determining whether or not a document is privileged or not. And note that in situations where the tax office or the federal police or both knock on your door, that if you are acting as a lawyer, you are the person that has to make this claim. You're obliged to help your client as best you can. You're obliged to make claims for legal professional privilege. It's not for the client to do, and it's not for the tax office to determine either. So that's something to note, that you as the practitioner have this duty, a positive duty, an active duty, to claim privilege in regards to documents. The way the courts describe this dominant purpose is with this phrase, that it has to be the ruling, prevailing, paramount, or most influential purpose for which a confidential communication is made. But a caveat to that is that it doesn't have to be the only purpose. It just has to be the main one. So there can be some other purpose, some commercial purpose, for example, by which a communication is made. That's okay, provided that the dominant purpose is to provide legal advice, and that it's not merely being done in order for that information to not be able to be adduced in courts. There are some really important limits to legal professional privilege. So the first of these is that it's a long-term common law rule, which is actually enshrined in certain places. So on the slide I've listed the Evidence Act, but it's in a variety of other places as well, where it says specifically that legal professional privilege applies in regards to documents, in regards to this piece of legislation or part of an act. But note that in situations where Parliament has clearly, unambiguously removed legal professional privilege, then it won't apply. Why? It's the doctrine of parliamentary supremacy. Ultimately, the clearly expressed will of Parliament enshrined in legislation will trump common law rules. That's the first thing you need to note. The next thing you need to note is that it's actually not a right per se. It's not a personal right. What does that mean? It means in practical sense that if you have documents, it's not about your rights being infringed as the client. Fundamentally, this is just a rule of evidence. So if that information is found to be made in confidence for the dominant purpose of providing legal advice, but the same information is sourced from somewhere else, you don't get the right to essentially use this as a sword rather than a shield. The idea is that the LPP is to protect information that's been provided in confidence, but it's not something that you can use to actively seek to prevent others from adducing evidence in situations where they've obtained the same evidence from elsewhere lawfully. Okay, it is a shield, not a sword. And finally, that you can't simply have a situation where you've got information and then call up a lawyer and try and channel it through that particular legal practitioner as part of it. This can come up in situations where you would have information that wouldn't otherwise have been subject to LPP because it wasn't made for the dominant purpose of providing legal advice, where you've got lawyers. So when you have people who are lawyers who are talking to each other, an Australian lawyer has a particular statutory definition, for example. And in that situation, you can't just click your fingers and create legal professional privilege as part of that. That's fundamentally not how this works. And so the courts go back and they look at the underlying facts behind how the information was created in the first place. Note from a practical perspective though, if you are a practitioner and the tax office and or the federal police have literally knocked on your door, you point to everything and say that it's privileged. Why? Because sometimes it's going to require more determination of things in regards to your clients, and there certainly is a better safe than sorry, provided that you're not being silly about it. You're much better off claiming privilege, then having the things examined afterwards to determine whether you're right or wrong, rather than trying to do it, particularly trying to do it quickly on the spot. Now, there aren't hard and fast rules about the amount of time that a particular, in this case usually a solicitor, amount of time they have to claim privilege is. The courts say that, look, the lawyers have to be given an adequate opportunity in the circumstances in order to claim privilege on documents. And the ATO are pretty reasonable about this these days, and they say that, look, they're going to give notice so that a person is going to have a reasonable amount of time to determine which ones are privileged and which ones aren't. Note that in situations where they reasonably expect that all of the documents are going to be privileged, for example, if you are a solicitor and you have files on a client, that you can reasonably expect that you can claim privilege on essentially all of that as part of it. So the ATO is going to give notice in that situation, but it is not legally obliged to. And so things can come up in situations where things fall through the cracks, and the courts will very much bend over backwards in situations where this has happened in order to prevent information like that from actually being able to be adduced as evidence. A very important point to note with legal professional privilege that sounds really obvious when I say it is that it only applies to lawyers, and the definition of lawyer is actually enshrined in legislation. It's Section 5 of the Legal Profession Act here in Queensland. And as such, if you aren't a lawyer and you're giving advice, legal professional privilege doesn't apply. It can't apply at common law. So all of these rules that I've explained in regards to LPP, even if you are providing information for the dominant purpose of providing tax advice or even legal advice, although you're not supposed to, it nonetheless isn't going to be privileged. It can't be unless the person doing so is a lawyer under Section 5. So what has happened though in recent times is that we've really come to both respect the accounting professionals amongst us and appreciate that in regards to tax matters, often they're the experts. The vast majority of accountants know much more about tax law than the vast majority of lawyers. That's a fact. So the ATO takes this into account. Now, in other jurisdictions, there is what's called this extension of what we here call administrative privilege. It's a lesser form of legal privilege. In other jurisdictions, in this case in the UK, they've recognized this and actually they've given it some form of legal backing, at least in the common law. There's support for that. That's not the law in Australia. However, the ATO, by convention, will go through and provide some component of privilege, even though they're not obliged to. So they are obliged to do it for lawyers. They are not obliged to do it in regards to communications that pass between non-lawyer professionals. And on the slide I've listed medical professionals, accountants, and similarly tax and financial advisors as well. What does this administrative privilege mean? Basically it means that the ATO, when they come knocking on the door, will deem information such as is produced between a tax advisor and a client to be held in a similar but not identical way that they would hold legally privileged documents and communications. So this administrative privilege is solely the creation of the ATO, and it is not created under legislation. This is only done by convention. So this administrative privilege, by the way, is not grounded in the profession of the person giving the advice. It's really to do with the documents themselves. So basically under the ATO's own guidelines, they will not seek things other than source documents, so records of transactions and information leading to those transactions. They won't seek these, what they call restricted source and non-source documents, unless there are some exceptional circumstances. And fundamentally, the ATO are the ones who get to pick those circumstances. So the more cynical amongst you can know that they can, if they want to, choose to just arbitrarily pick one or the other. So these restricted source documents, so they're the ones that aren't usually going to be obtained by the tax office as part of their information gathered under either of the two limbs of 353. These are documents that are actually prepared by external accountants, so that they are done for the purpose of advising on tax-related matters. All right, so that information that is advising on tax-related matters in regards to arrangements or transactions. So that's written in broad terms, but the idea is that it has to be prepared. They're restricted if they're prepared by external accountants. And the other classification of documents that they won't usually grab are these non-source documents. Those are advice papers. So where you've got what they call restricted source documents that are created by external accounting professionals, these non-source documents are things that have been done or have been created, but don't materially contribute to tax strategy. That's really the key thing here. So they're usually to do with things that haven't happened yet, or things that they are transactions that business is thinking about going through and doing, but not the tax strategy that relates to those things. So that information is not usually grabbed by the ATO as part of that. Okay, and that includes, in this situation here, working papers where there is currently an audit, and here the slides have mentioned engagement letters or audit plans, so that those are documents that aren't the complete audit, they are plans and structures for going about doing an audit. And again, these and due diligence reports as well. So that this, where we've got documents that relate to those processes, but that are either works in progress or don't relate to tax strategy, the tax office will consider those to be non-source documents, and by default they won't take them unless there are some exceptional circumstances. There is a word which terrifies a large number of taxpayers in this country and probably all other countries, and that is the thought of having an audit by the tax office. That is a situation where the tax office will assign staff to examine the transactions and assumptions, elections, and decisions that you've made as part of a self-assessment process to ensure that you've done it properly. That's what an audit is. And audits cannot be done for every taxpayer. It would be vastly too expensive. They are done only for particular taxpayers, and they're done for two purposes. One is to educate taxpayers, I suppose, hand on heart, to show people how to go about fulfilling their obligations properly. I guess not all taxpayers have had the joy and privilege of undertaking advanced taxation law subjects at university level. The other purpose is far more cynical and I guess far more important, and that's to deter others. If you have the threat of an audit, some fraction of taxpayers will structure their affairs properly. They will not make such cavalier assumptions. They will not take such make such outrageous deductions in regards to their expenditure, and they won't adopt very, very outlandish positions if there is a real and genuine threat that they will get audited. Some fraction of taxpayers respond to this, and that is why the ATO, one of the reasons why the ATO conducts audits. There is something I want to note, which is on the slide, which is this very simple fact that while there are some random audits, those fractions of audits are very, very, very minor. Most audits are not random. Most audits have come about because the ATO has done data matching, and you've got unusual transactions. You've gone through and had some entities that you've been dealing with have structured their affairs in an unusual way, and the amounts don't align with similar taxpayers, either in the same industry or the same class, the same wealth class, and or the transactions that you're claiming, again, particularly in terms of income and expenditure, don't align with your particular traders. The ATO has an extensive data matching process, and it is becoming better and better over time. As a result, hand on heart, I can say that most audits that the ATO undertake are not done on a purely random basis. Many people picture the ATO as being this great monolithic entity, the evil empire, and think of it as a great adversary that needs to be fought against forever and a day. Nothing certain in life except death and taxes. However, that's really not, in the real world, that's not what happens. It's not how the ATO is structured. The ATO is a very large entity. It has a lot of staff, and a good fraction of that staff are actually to do with what we would call in the private sector customer service, so to speak. And this ATO client engagement team is tasked with going to try and make it easier for people to do the right thing, to make it easier for them to be able to lodge accurate returns, for them to be able to do it simply, to reduce the time it takes for them to do it, for them to be happier doing their tax returns. I know it's a crazy thing to think about, but it's an important one, that we are all going to have to engage with the tax system at some stage. And it's an entity like any other that in our highly regulated society that tries to do things better. And so the ATO client engagement and the various components of that, that's fundamentally their role. It's to really try and bridge the gap between taxpayers and the tax office to make it a smoother process overall. To achieve this, the ATO's client engagement group, this CG, is a very large component. It's one of 5 or 6 sort of operating divisions in the ATO. And it's really about improving the compliance of taxpayers to do things. And so it's split up into, so I think 7 teams at the moment on the slide there. So you've got one team which is to do with individuals and intermediaries. The idea here is that having a team which liaises with tax agents. And that's a team that tries to smooth things out between taxpayers by going through and managing the process in which they interact with tax agents and BAS agents. And another team is the integrated compliance team that looks at non-compliance. So the fraud and criminal activities, they're the ones that go through and do that examination of that process. You've got a private wealth team, which handles large net worth individuals and entities. So you're considered to be a wealthy, according to the tax office, when your assets hit $5 million. And then there's another step whereby you're extra wealthy at 50 million. There's a public group, an international team, which looks at public entities and their tax compliance, as well as large sort of publicly traded entities, trusts and partnerships, as well as international strategies. There's a small business group, which looks at sole traders and small trusts and partnerships where you've got turnover less than $10 million. There's a data analytic team, and there's a team that looks at superannuation and the obligations of employers as well. So in conclusion, this client engagement group really looks at trying to build better relationships between taxpayers and the ATO and a variety of other groups, tax-related groups as well. That's really where it's at, and that's why government agencies in modern times pour non-trivial amounts of resources into doing that, because we need to maintain confidence in the system. So we need to actually have public faith that our system is fair, it is transparent, and that the vast majority of people comply with their obligations. In other words, do what they're supposed to do. People doing the right thing, doing it in a seamless way is really what this ATO client engagement group's about.